Hi, quick update for myself, Harvey Goldman, and no cuts, no edits, no filters, and no hair. So as you can see, I've got gimbal and it's auto tracking, which is enabling me to look at a screen. So, I think it's lost me, there we go. So, I wanted to just really touch on things like pensions and investments, something that until today, I knew comparatively little about. And my God, there are almost endless options out there. It has become apparent that you need to fact check a lot of what you read on the internet. Like literally everything. You need to get sources, you need to double check all the information you're told about investments and pensions, because a lot of it is complete codswallop and a lot of it is absolutely wrong. So I've got some notes on my screen, so you'll forgive me if I look away. But yeah, so basically, given the UK's current economic landscape, especially going into 2025, I think the IMF, which is the International Monetary Fund, has predicted growth of around 1.6%. which allegedly makes the UK the third strongest economy in the world. I don't know how I feel about that. I mean, the sources that this information's coming from, I've got Reuters, I've had a look at Goldman Sachs, II.co, Money Helper, The Telegraph. So they should be credible sources. So obviously don't take anything that I tell you as investment advice. I'm simply stating the facts as I've been made aware of them. So there you go. So basically the IMF have predicted a growth rate of 1.6%. Other economists are predicting it could be as low as 1. I'd say that's cautiously optimistic. I still think that we're headed for a free-fall recession, probably before the summer. But there you go. So in regards to investments, I've got a bit of crypto. I've done crypto since about 2014, so I missed the early days of Bitcoin. I did jump on and I invested in Bitcoin Cash, Litecoin, Ethereum when it came out a year or so later. And I did make some money on them in the early days, and it was ridiculous because at that point they weren't taxed. There was no requirement to declare them. And it was literally like the Wild West. So there were people just setting up Telegram messenger groups. There were pyramid schemes, there were pump and dumps, there were all sorts going on. It's a little bit more regulated nowadays. I see crypto as still being a high risk investment option, and I see it as something that you probably shouldn't put more money into than you're willing to lose entirely. So I'd liken it a bit like going to Vegas. If you go to Vegas, you should basically be prepared to lose everything. However, I don't trade crypto anymore. The crypto that I buy, I simply stack and I just hold on to it. So what I do, if it crashes, it drops incredibly low. Yes, the overall value of my portfolio may go down. At that point, I buy more, as long as I've got the free income to do so. And then in the last few months that we've seen, well, certainly since just before Christmas, it's gone up almost by, I think it was about 80k at one point. I think it might even be about 85 now. I've not checked. So yeah, it leapt from about 55, 60 up to 85k or thereabouts, which is an incredible leap. And on that basis, I had made money, but of course, like any investment, you only make it and you only realize it when you pull it out. So it's nice to see that it's growing. I'm not going to lose any sleep over it. For me, crypto is one of the things that I put money into. And I guess for some, it's a bit like an ISA. I don't check it. I might check it about once every 6 months and go, that's nice. And at that point, I'm done. So that's a quite high risk investment. Even though it doesn't require me to do anything to it, it's still high risk because of the volatility of the market. and the fact that a lot of the coins are meme coins, or like, shit coins as they call them, and they're not perhaps as steady as the big three, which would be Bitcoin, Solana, and Ethereum. So onto some low risk investment options, and again, I'm sorry I'm referring to my screen here. So basically government bonds, gilts. So government bonds are traditionally seen as safe investments, and they provide predictable returns. However, with the anticipated interest rate cuts by the Bank of England in 2025, the yields could be influenced. So this could basically sway the market and affect them either way. You've obviously got low risk options such as savings accounts. The interest on those is typically really awful. I think I've got a Santander 123 account that I believe I pay about £4 or £5 a month to have the account, and the interest on the account is about 1.5%, something like that. It's pretty pathetic. ISAs don't fare much better. I did have a look. In fact, I did open an ISA about 3 weeks ago, just before Christmas. I didn't put any money into it yet. I am planning to. But the ISA rates from the high street banks are, again, typically not that great. They're hovering at around 3%, 4% thereabouts. I found a Virgin Money ISA, which is a sort of hold one. You can basically pull your money out 3 times a year without being penalised. Any more than that, and you basically get penalised for it, either by fees or by loss of the accrued interest. So the Virgin Money one, it was 6.5% when I signed up. I think it might have gone down to about 6.2 at the moment, but that's obviously almost double what the high street banks are offering. So I do plan to start putting some money away into the ISA, and I am going to be using the Virgin Money ISA. Tripped over my tongue now. I had an awful lot of coffee to stay up and review all this stuff. So those are some quite low risk ones: government bonds and savings accounts. So obviously, when you're investing in anything, you want to look at diversifying your investments. Whether you're investing in the stock market like the FTSE, whether you're buying cryptocurrencies or whatever it might be, you want to look at not sticking all your eggs in one basket. So for example, in my case, when I had a full-blown crypto account going, I had at one point, I think probably about 40, maybe even 50 different types of coin. Now, some of these were NAF coins that they print trillions of, and you end up with 50 million coins for like £500, that kind of thing. And some of them were big players like Bitcoin and Ethereum. So it's much better to diversify your portfolio. That way, if one of them tanks, you don't lose everything. You have got options there, and if you've got growth in one area, you may be able to take a fail in another, and it won't hurt you as badly. So it's always best to diversify. So stocks and shares are the obvious one. You can diversify between different sectors like technology, like healthcare, and so on. You could also do what they call index funds. So that's basically, instead of you going onto a trading platform, for example, like 212 or Robinhood, something like that, you can basically, instead of you going and buying a Bitcoin share, a Google share, a Meta share, you can just invest in a fund. So the fund is owned by a company that basically go out and they source loads of shares. They might have 100 different companies they've got shares from. And your investment is you investing in their ownership of all of those different shares. So they might spread it over 100 different shares, if you like, 100 different assets. And your portfolio, the predicted gains on these types of fund is usually around 7 to 10%. I tend to hedge my bets again towards the lower end. I'm never angry if I get surprised by money, but I would get angry if I hedge my bets on 10% and it rolls in lower. But 7 to 10% on index funds, and they're really easy. They're the type of thing that you just buy into, and you forget about it. You might check it once every 6 months, once every 12 months, and it's basically like a retirement fund. I see them as probably being better value for money than a pension. I haven't found a pension that can produce the same types of returns as index funds, put it that way. So the next one would be real estate investments. Now, this is a tricky one, and you really have to be very careful. Now, obviously, you've got direct property investment. So property values, traditionally, they've gone up and up and up. And I think back in the 1960s, you could buy a house for £5,000. Now, I mean, where I live, you're lucky. Honestly, you're lucky if you can buy a house for 300. I bought mine, or rather bought the mortgage on it in 2019, just before the advent of COVID. It's a 3-bed, 2-bath. It's got a garden, front garden. It's got a garage, off-road parking, all the rest of it. It was up at 220. I managed to beat the lady down to 210. So I paid 210 in 2019. Right now, my place is worth 350, which is bonkers. That's absolutely bonkers. Now, I'm sure that the property market is going to suffer this year. I'm sure that it's going to crash. I don't think the crash will be as dramatic as people are perhaps hoping it will be. And I think property is one of those things that traditionally is just going to keep going up and up and up year in, year out. And I think if you look at the grand scheme of things, although yes, there was a bit of a crash in 2008, and yes, there was another crash, I think it was 2018, 2019, they weren't massive. And it didn't affect the market for long. I think within 2 years, it had kind of gone back up to its value. So property investment, you do have to factor things in like interest rate charges, because obviously that can influence the returns. If you're buying properties to flip them, you've obviously got things like your stamp duty tax, which has gone up again, I believe, this year. You've got the cost of any renovations that go into it as well, and also whatever the market's doing at the time. Market conditions can massively affect how quickly you're able to flip that property. And let's not forget that while you're waiting to flip it, as the owner, unless you've got somebody in there, short-term tenant, that kind of thing, you're still paying the bills, you're still paying the council tax, you've still got to pay the fiddler. So all of these things need to be factored into it. You've also got, within the same realm, real estate investment trusts, or REITs. So these basically allow investment in the property markets, but you don't directly own the property. Now, I'm not going to lie, I've not researched too much into those. I didn't have the time. But I think from my end, if you've not got direct ownership, I wonder how the performance of that is actually sort of affected by the market. Yeah, I'd probably stay away from that, to be fair. Obviously, pension strategies. This is the other big one. Now, most of us pay into a workplace pension. I have certainly for about 10, maybe 12 years. Before that, I didn't bother. I didn't see the point. Now, obviously, there are people that are entering the workplace now that will never not have been enrolled into a workplace pension. I think up until I was about 30, bearing in mind that I'm 37. So I think up until I was about 30, it was entirely optional. And before that, it wasn't even a thing. Now, obviously, you've got employers' contributions that match or exceed what you put in. I think from my end, I think I pay about £100 a month. And I think my employer puts about 150 in, something like that. So it's not a massive amount of money. It probably accrues something like £3,000 a year. I have got 3 different workplace pensions. I find that they're a nightmare to keep hold of, to keep track of. Every time you get a new job, the employer uses a different provider. And it would be much easier if there was an easy way, like a centralised hub where you could just push a button and it would draw them all in. As I found recently, that's not the case. There's an incredible amount of paperwork. And in my case, I have to do that 3 times, which is not cool. It's an absolute time sink. However, once it's done, and I am still in the process of doing that, it will enable me to track the performance and growth of that pension. Again, it's something that I'll probably only look at once a year, and I think I wouldn't even bother doing it off my own back. It'd be when they send me an email saying, by the way, this is what your pension's done in the last 12 months. It's sort of fire and forget. It doesn't mean anything at the moment. I can't do anything to it. I can't draw any money from it until I'm at least 55. All I can do is pay extra into it. However, I don't deem, although I've got the pensions, I don't deem them to be as good of an investment as index funds for myself. So any spare money that I've got is going to go into index funds, and that's simply the way that I'm going to play it. Hopefully from there, I can take advantage of the compounding effect and just keep reinvesting any profits back into the funds, and just, that growth will be there. Obviously, you've got self-invested personal pensions, which are SIPs. So they offer flexibility in investment choices. You've got things like stocks, bonds, funds, lots of diverse options there. And they can align investment risks with risk tolerance. And obviously you want to align that with your retirement goals, whether you're going to aim to retire at 55 or the now state age. I think it's gone up now to 66 or 67. Probably by the time I'm state age for retirement, I will literally be about a year from being in my box. I reckon I'm about 20 years off state retirement age at the moment for a male in the UK. What are the odds that it's still going to be 67 when I'm 67? They'll have moved the goalposts, they'll have diminished the amount that the state pension pays out by then. So to be honest, I think I'll be lucky to actually get a state pension at all. I honestly don't think there'll be a pension whatsoever by the time I'm eligible for one. Now, my partner is state pension age in about 8 years. She's 10 years older than me, and I believe it's still 65 for females. She is adamant that she wants to carry on working, and I'm like, look, you do you, that's absolutely fine. If you want to, it's your choice. I have got a little plan on the back burner. I want to get myself into a position where I can earn enough money so that she doesn't have to work really past 60. So in the next 3 years, I want to be bringing in enough income to cover my wages, my partner's wages, and fund money. And I'm going to retire her. I'll buy her a dog, whatever she wants, and she can just be retired and live the life of Riley. What a stand-up guy. I wish somebody would do that for me. You've got things like alternative investments. Now, these are things like commodities, things like gold. Gold is pretty much the most guaranteed protection against inflation and economic uncertainty. You pretty much historically will never lose money on gold. And that's really all there is to say about it. You've got Sharia compliant funds. Now, I didn't have time to look into these. They did pop up. I've got it all in front of me. I can't waffle on about that. I know nothing about it. Now, some practical advice. So this was practical advice. What I did, I fed all of the articles and all of the sources that I come across where all of the previous information has been drawn. I fed that into ChatGPT. And I'm a massive advocate of AI. Obviously, part of my day-to-day, my 9 to 5, is using AI daily to meet various ends. I have run the results from ChatGPT back into ChatGPT 3 times, and each time fed it back in and said, look, this has come from a source that I don't trust. How do you rate this information? And it's critiqued itself unknowingly. And we've gone through that process and filtered it down. So this is the practical advice from AI, our future robot masters, as it were. So to navigate the 2025 financial landscape effectively, number 1, regular contributions. So consistently investing, even modest amounts, can leverage compound growth over time. I completely agree with that. Professional consultation, i.e. not me. Engaging with financial advisors can provide personalised strategies tailored to individual circumstances and goals. Very sage advice. And the next one, stay informed. keeping abreast of economic developments and policy changes ensures timely adjustments to investments and pension plans. Again, very good advice. From my own end, my own advice is, as I said, never bet the house. Never put all your eggs in one basket. What I've learned over the research I did last night and also today, and also consulting with Money Supermarket and Reuters, Goldman Sachs, ChatGPT, and all the rest of them, don't put your eggs in one basket. If there's ever a truer word, diversify your investments where you can. Obviously, the compounding effect is massive. That's a whole other video in itself, I'm sure. If you've not come across compound interest, check it out. It's something that's not taught in our UK education system. It is an absolute travesty. If I knew about compound interest when I was 16, I wouldn't have spent 11 years until I had my kids partying and, peeing up against the wall at weekends. I literally would have been putting that money into the stock market, perhaps into property, perhaps into anything that was going to make more money. And then, realizing the effects of compound interest. So if there's one draw from this, go and look at compound interest, and then look at stocks or look at investments or even crypto that's got a barrier to entry that allows very small, very modest investments, even if it's a very small amount weekly, that will then grow over time. And that will hopefully set you up. And you'll be surprised, although that there are various websites and various YouTubers far more clued up than myself that have done compounding graphs and they've done realized gains graphs. And literally it starts off very slow like this. Then it builds, and after 5 years, it's up here, 10 years, and then suddenly it's like Elon Musk's rocket, it's to the moon. So check it out, and yeah, let me know in the comments. What are your investment strategies? What's worked for you over the years? Have you got a magic bullet when it comes to picking stocks? Let everybody know. Goldman, peace out.